Mark with Right Line Trading, and I just wanted to start with this disclaimer that all signals and trading opportunities provided by the company are for educational demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers within the futures forex markets or for any profits or losses that may be incurred. Traders should know that trading is risky and that you can lose a substantial amount of money. Therefore, participation in the market is not appropriate for everyone. Never trade what you cannot afford to lose. Do your own due diligence. And those of us here are not registered financial advisors nor licensed commodity trading advisors. Now, I see emails all the time telling me to never buy options, and when you open them up, what they're doing is telling you to sell options. Well, the question of whether you buy or sell options is not quite so clear-cut as they may make it out to be. The fact is, if you want to take a position on a stock, say like NVIDIA, there are a number of metrics that you can look at to decide whether you want to buy or sell. Now, first, if you're bullish on the position or bearish on the position, it's really irrelevant. You have to decide whether you want to buy a call or just buy a put. Now, with NVIDIA being as expensive as it is, that may be prohibitive for you if you don't have a very, very large trading account. If you want to limit the expense of the position, then what you're going to do is you're going to trade a vertical spread. Now the question is whether you buy the spread or whether you sell the spread. It does not matter whether you're bullish or bearish on the stock. The question is whether the price of the options themselves are cheap, in which case you would buy the spread, or if the price of the options is expensive, you're going to sell the spread and you're going to keep the premium because potentially it may be a nice, fat, juicy premium. What do you do to determine that? Well, we've sort of solved that problem right here. And if you look at the at the cyan histogram here, or the magenta histogram, this is historical volatility. And this always tracks back 1 year. And this is going to tell us what the market, on a historical basis, believes that NVIDIA is going to do in terms of volatility. The cyan line is implied volatility, and that's what is going on right now today. Is implied volatility greater than historical volatility? And if so, is it significantly greater than historical volatility? Now, if it is like it is right now, if you would buy a bullish vertical spread, you would sell it because the price of the options are very high. The reason is on the 24th of February, NVIDIA is going to be reporting earnings. Earnings almost always increases the implied volatility of the underlying stock. That's exactly what we did. We sold NVIDIA for a really, really fat, juicy premium. And we're going to hold and make a decision right before earnings whether or not we're going to hold through earnings or not. But given the trajectory of NVIDIA and the way we got it on a big pullback today, we're hoping for a nice move up. We've got a nice, fat, juicy spread. But the key is, if implied volatility is significantly greater than historical volatility, you are going to sell the spread and take the premium. If implied volatility is lower than historical volatility, you're just going to buy options on the cheap. You're going to create a nice vertical spread for a very inexpensive price. All you have to do is look down here and take a look at the magenta histogram versus the space between that and the cyan line, which again is telling us the magnitude of implied volatility. I hope this was helpful in your options trading, and that you have a really wonderful evening, and I look forward to talking to you tomorrow.